And today we are going to be talking about trading breakouts. As a matter of fact, this session is the second part of a 4-part series. Your ear indicator says the sound is fine. That is great to know. My ear indicator is a lovely woman at home, and she tells me that sometimes my sound is not fine. But anyway, this is the second of a 4-part series, and we're going to be talking about, it's a series on limit orders. And so one of the things that I want you guys to walk away with today is how to incorporate limit orders into your already strategies that you're using and already popular strategies. And one of those strategies that we're talking about today is a very popular and yet a very effective strategy in trading breakouts. And in order to be able to effectively trade a breakout, it also helps to know what types of market conditions help foster those breakouts and how to identify those market conditions. So throughout the course of this webinar, I'm going to take a couple of minutes. We're going to highlight different order types, market orders, the stop orders, the limit orders, and then we're going to show how we can use limit orders and why it's important to use limit orders in using a breakout environment. And then, of course, we'll be looking at some charts and hopefully walk away with a couple of trading ideas. We're getting pretty close to one right now, and may not develop here for a couple of days, but we're very close to a price trigger on one of these right now. So let's start off with going over the market order type here. And when you're placing a market order, basically you're saying, I want to get in or out of the market right now. So you want to get that execution guarantee, but you may not get that price guarantee. You could get executed at the current price that you requested. You could get executed at a worse price. Many people are familiar with that with regarding to negative slippage. Or you could get out at a better price, and that would be positive slippage. Another order type out there is the stop order. And this is where you want to get executed at a price that is less favorable than what the current market is trading at. So, for example, if you're long in the market, if you're a buyer in the market, and you're already in the market, you're going to want to place a stop below the current market price, meaning you want the prices to move up. So if the prices move down, that is a worse price than where the market is currently trading. And market orders can get triggered at the requested price. They can also get triggered at a worse price as well. Now, limit orders, which is the highlight of this series, those are placed at price levels more favorable than the current market price. So again, if we are long in the market, if we're buyers in the market, and we want to take profit at a higher level, that means we're entering a sell order at a much more favorable price. Now, the good thing about limit orders is that you can get executed at your requested price, or you could also get executed at a better price, known as positive slippage. Now, there isn't that opportunity to receive the negative slippage on limit orders. So that's why we want to highlight that, the limit orders that is, in a sense that we either get out at the price that we want. Okay, so there's the summary of the different order types, and today we're going to be going out and identifying potential market conditions for breakouts. And then the next webinar that we do in 2 weeks is actually going to go into another specific strategy on breakouts. So what we're going to be looking for in looming breakout environments is an extended period of low volatility. And one of the tools that we're going to use to help us identify a period of low volatility is the Bollinger Band width oscillator. So what I want you guys to do is I want you guys to type in the chat box how many people are familiar with the Bollinger Band oscillator, how many people are not familiar with that Bollinger Band oscillator. It is similar to the Bollinger Bands, and I'll show you on a chart what those similarities are. Looks like we're getting maybe about 2/3 of the folks are familiar with it, and 1/3 of the folks are not familiar with the Bollinger Band oscillator. And we'll get into some of the mechanics here in a moment. And then we're going to wait for prices to break above and below the support and resistance levels, and then use a 1-to-2 risk to reward ratio. All right, so let's go to the charts. I'm going to pause for a moment here and turn the camera off and then turn it back on the chart here, so just a moment. Okay, so you guys should be able to see my chart right now. I've got it set up on the AUSSIEN daily chart. We've got about a year's worth of data candles. And there's only two things on my chart right now. Obviously, we've got the price candles. And then down below, this guy down here, this is the Bollinger Band with oscillator. Now, many charting packages will have this as a separate indicator that you can add to your chart. And this charting package that I'm using, Market Scope Charts, it does not come natively with it, but I can show you how to add it. There's no charge to add it. It takes about 2 or 3 minutes to add it, and then it's always there for you to use. And so if you are interested, send me an email. Let me just put that out there at instructor@dailyfx.com, and I'll share with you how to get this added to your Market Scope charts. So I'm going to add another indicator, the Bollinger Bands here, so we're going to see how this Bollinger Bandwidth decimal oscillator is created. Now, many folks, when they're using the Bollinger Band indicator, they're going to use a 20-period simple moving average and then 2 standard deviations. So I'm actually going to stretch that out a bit. I'm going to use a 50-period simple moving average and 2 standard deviations. And so you'll see my Bollinger Band show up here on the chart. Now what the oscillator does is it is simply taking the distance in pips between the upper band and the lower band. And then it plots it as this histogram down below. So as you can see here, the larger that this oscillator is means the larger the distance is between the bands. So you can see the bands are fairly wide right here. And then as this oscillator begins to move down, that means that the bands are moving closer and closer together. Now, why is that important? The reason that that's important is because one of the great things about using Bollinger Bands is it has a volatility filter built into it. And it's some complicated math, or if you were good at math in college, then maybe it's not that complicated for you. But for most people, it uses a standard deviation from the simple moving average. And so basically the larger that the candles are, then the wider the standard deviation becomes. So you can see here we get some pretty monstrous candles back in May of 2010. You'll remember that was the flash crash. Some very huge volatility figures, and therefore as that volatility stretched out and became larger, the distance between the upper and the lower Bollinger Band began to stretch out as well. And that's where we saw this move up significantly. Now, when we're looking to identify a breakout environment, remember from the slides that one of the things that we're looking for is an elongated period, an extended period of low volatility. And so what that means is we want an extended period where the Bollinger Bandwidth oscillator is very, very small. And I've got the AUSSIEN up here for a reason, and that's because the distance between the upper and the lower Bollinger Band on using a 50 simple moving average and 2 standard deviations, the distance between the upper and the lower Bollinger Band is at levels not seen since, get this, levels not seen since December of 2006. And so it is a very, very quiet period out there on the AUSSIEN pair. And actually there's a couple other pairs which are somewhat related to the AUSSIEN, which are showing very low levels of volatility as well. So what this is telling me is that we've got the possibility, low periods of volatility tend to lead to higher periods of volatility. What this tells me is that we may have some volatility coming up on the horizon. I don't know what direction that these prices are going to go, but I can tell you one thing. By looking at this chart, actually let me move this out a little bit. And let me just take this all the way back to 2006 so you can get a sense of what the historic volatility has been according to this oscillator. So you can see this is where we're at today, and these are levels that we have not seen since late in the year 2006. Now, since then, we've seen some serious volatility. Remember, in 2006, it gave way. 2007, we started to see some increase in volatility. Prices on this Aussie-yen pair are about 20% lower than where it was, so not any significant movement in one direction or the other, but we did get some pretty large candles over the course of the last couple of years, and a very large sell-off in 2008. And you could see that the volatility really went screaming to the upside. Here's that flash, here's the flash crash, led to this period of volatility in May of 2010. So now that we're establishing that this is a daily chart, Gino, and now that we're establishing that a period of low volatility tends to lead to higher periods of volatility, we don't know when that's going to happen. We're just using that as a sign. We're just using it as a road marker that says, hey, if you see a construction site alongside the road, it's warning you. It's saying, look out ahead. You want to make sure that you turn right up here. You're going to fall off the edge of the road. Well, that's a similar type of thing that this is telling us. It's giving us a clue that there's potential volatility coming up in the market because things are extremely quiet right now on the Aussie yen. And the Aussie yen, you're matching up one of the higher yielding currencies in the Australian dollar against a relatively and historically low Japanese yen interest yield. And so this could take on the personality of being a risk trade, risk on, risk off type of thing. And so when it's very low volatility like what we're seeing now, people are becoming complacent in the market. And Harley, our question here, does the Bollinger Band oscillator really bring more info than just the Bollinger Bands? Well, I can see part of what your question is in that the oscillator is constructed as a result of the Bollinger Bands. So you can't construct the oscillator unless you construct the Bollinger Bands. Now, what does it really tell us beyond that? Well, if we take a look here, and if we zoom into the most recent price action on the Aussie yen, notice that my Bollinger Bands are moving sideways. My 50-period simple moving average is moving sideways. I have a historically low Bollinger Band oscillator. And so that is telling me that the market is very calm and it's very comfortable with where it's trading right now. And after a period of comfort, people lose interest in it, and then that's when you tend to get breakouts that follow periods of low volatility like what we're seeing here. Now, how could we place a trade based on knowing that a breakout environment might be looming? So what is it that we're actually looking for in breakouts? Were you looking for a break above resistance levels, or are you looking for a break below support levels? And so, again, one of the most common input settings for the Bollinger Bands is people like to use the 20-period simple moving average, and they like to use 2 standard deviations. So if you want to look for a breakout trade, one thing that I will do as well is I will come out and I will change 2 standard deviations into 1 standard deviation. And that basically just tightens the bands up. And then look for a break above the upper band, or you could look for a break below the lower band as your trigger into the trade. Now in this case, the lower band is very close to the lows of these candles from last week and earlier this week. So it may be wise to go ahead and look for an entry order to go short below the 81.45 area. And then what you would do is you would place a stop. This is a daily chart, so the strategy you're going to want to use on a daily chart, place a stop just above the high of the candle that breaks below. So obviously we're not in a trade right now, and we're about maybe 40, 50 pips away. Let's say something happens in the market, prices at the current 81.87 level. Let's say it moves to the downside, we break below this 81.45 area. Well, the high of this current daily candle is what we're going to want to use to place our stop. And then we're going to enter in around the 81.45 level. So that means we're going to have, my high is around 82.05. Let's place 15 pips above there. So that would be around 82.20. So if my math is correct, I take 82.20 minus an entry price of 81.45. That's 75 pips. I'm going to look to take twice that as a take profit level. So 150 pips is my take profit level. Place a limit order to take profit at 150 pips, which would be around 82.95. Now that is assuming that prices turn tail and head directly south from here. It may continue to be range bound here for the next day, next week, next month, who knows? But I'm simply waiting for prices to break this range in anticipation of this quiet volatility leading to more expanded volatility. And it's good to see we've got Paul Volcker in the room. It's been a long time since we've talked, Mr. Volcker. The AJ used to track really well with the S&P, but not anymore. I think you're talking about the Aussie yen here, that it used to track very well with the S&P as far as being correlated to it. And I haven't run any correlation numbers to these lately, but I would say that, yeah, lately they have not tracked. Because if you think about it, the S&P 500 has been on a tear to the upside, and the Aussie yen, meanwhile, has been trading sideways. So I would agree, though I don't have any numbers to prove it, I would agree that, yeah, lately they haven't tracked very well. And that's what you're going to find in the market, is that correlations will come into and out of favor. There will be times there will be high correlations in the market, and then there will be times where there just doesn't, the correlation doesn't seem to match up anymore. But I would suspect that if this Aussie yen does break out and we do get a risk-off trade, I do think that that would filter over into other areas and other markets, like the stock market. And Boyke says, why did I change to a 1 standard deviation? Okay, the reason of changing to the 1 standard deviation is that's going to be our trigger to enter into the trade. Okay? Now, you can still use a 20-period simple moving average. Let me change this around a little bit. And let me just show you an input setting that many are familiar with, the 20-period simple moving average. And if you just change it to 1 standard deviation, a lot of times what you'll find is when prices break up above, in this case, the upper band, that a lot of times it will ride along this upper band. And so that would be your trade. You wait for a break above, and then you could either use a 1 to 2 risk to reward ratio, or you could wait for prices to move back inside the band. And so even here, during the flash crash, prices moved outside of the lower band, and they tend to ride along and stay below the lower band, as it did in this case. And just about any currency pair you could do that with. So let me go ahead and change currency pairs here for a moment. Let's take a look here at the euro dollar. You'll notice that anything that's US dollar related tends to have a strong trend associated with it. And so here's a period where the Bollinger Bands were moving sideways. Now this oscillator down below is based on a 50-period moving average. So let me go ahead and remove it. The bands are moving sideways, relatively tight together. We get a breakout to the upside. Prices walk along the upper band. We'll get another breakout to the upside. Prices are walking along the upper band. So that's the reason why that's the reason that I would look to use the 1 standard deviation, is that when you do enter into a strong trending move, that 1 standard deviation tends to be a nice barrier for prices, meaning it tends to, in this case, when you break out to the upside, support the prices to the upside. And when that upper band gets broken back, when prices move back inside that upper band, that would indicate to you that this trend is exhausting to the upside. And you can see this trend exhausted. It ended up creating a higher high here in early November, but it had a lot of shakeout. It lost its momentum and only poked above very briefly. And then it went on this downward move. Which, by the way, checking this out on the daily chart on the euro dollar, we've got a doji-like candle formation, another doji-like candle formation if prices were to close where they're at today. So that's two out of 3 days of a doji. So this thing looks like it is running out of momentum to the upside. Got another question here. Where would you look to take profit? Now again, let me go back to this example. Let's say I was trading the euro dollar, and this is what I'm looking at right here. So I'm gonna move this chart to the right. So boom, I get a close up above my upper band. So I'm going to go ahead and enter at the market on the close. I'm going to place my stop just below the low here, and I'm going to calculate that distance between my entry and the stop and have a take profit level, a limit order of twice that distance. And so then as we progress on forward, you could see that the stop would have easily been taken as we took off to the upside. What is the ABC on my chart? It's a good question. Posting some trades really doesn't have anything to do with this this webinar, but using some Elliott Wave, and that this may be a 1 move to the downside, ABC 3-wave corrective pattern, wave 2 looking for it to exhaust here anytime soon, and then wave 3, which, as you guys know, tends to be one of the strongest waves in the Elliott Wave theory, and so anticipating a strong move to the downside, and that would also fit in well with what we're talking about on the Aussie yen trade. Okay, I'm going to change charts here for a moment, because as you guys know, the dollar has been getting weak here lately, but it hasn't produced any lower lows yet. So if this does turn and the dollar does get strong, a risk-off trade is one of those components that could create that. Could be a variety of reasons as well. And by the way, on the Elliott Wave that I was talking about there, that 1 and 2 and ABC, on February 23rd, at this very same place, is when we're going to be talking about Elliott Wave and Fibonacci and incorporating, and how you would incorporate limit orders and using Fibonacci and Elliott Wave theory. So there'll be more on that coming up on February 23rd. Wiki says, is it true that most breakouts fail? Well, I think it's true to say that most trades fail, and it's okay to have more losing trades than more winning trades when you're out trading the market. It's very common. A lot of professional traders will have more losing trades than winning trades. They'll have a less than a 50% win ratio. You see what happens, and what delineates a professional trader from your average trader or your novice trader is that the professional trader studies the chart and identifies those high probability zones. So if there is not any trading opportunities presenting itself right now, well, they're going to do nothing. However, they'll look at the chart, identify high probability trading zones, and then they try to exploit and capitalize those high probability trading zones. And there may be days when there are a lot of trading opportunities flashing itself left and right. As soon as you get done with one, it seems like another one is presenting itself. And then there are other days where you would be better off going off and playing ping pong or going to the gym. Now let me point out a couple of more currency pairs here. I want to go back and add this Bollinger Band width oscillator, and I'm going to use a 50 and 2 setting. And I want to show you something else that's a little interesting that I was preparing for this webinar. And actually, Boinky, we took care of your question on why we use the one standard deviation. What's the reason for the 50? And that's Gino's question. Don't remember if I answered that yet. Basically, the 50 is just the 50-period simple moving average. And so when you're using the Bollinger Bands, the common default setting that comes when you're installing Bollinger Bands onto your chart is the 20 and the 2. 20-period simple moving average, 2 standard deviations. Perfectly okay to use that type of setting. Where does the 50 come into play? Well, the 50 is a very popular moving average. You'll hear about a lot of people using the 50-period simple moving average on their charts. And so that's why I like to use it on the Bollinger Bands for 2 reasons. Number one is that it's incorporating 50 days worth of data. So when we are seeing low volatility, according to the Bollinger Band with decimal oscillator, when we see periods of low volatility, this doesn't mean that this has just recently happened over the last couple of days, last couple of weeks. No, this has been this low period has been going on since probably 2 weeks. And then you got to figure that there's 50 days worth of data going into that calculation. So then you got to back off probably another 10 weeks, because 5 days a week, 10 weeks is going to be 50 days. So we got about 12 weeks of low volatility coming in on the Aussie yen currency pair. It's that 12 weeks of low volatility that's created this very, very low distance between the upper and the lower Bollinger Band. And again, we haven't seen this since December of 2006. So it's been a very long time since the market, the Aussie yen market, has been this quiet. And getting back to the point, I forget who made it, Paul Volcker, that's right, about the correlation between the Aussie yen and the S&P. Things have diverged on that correlation lately. Now, at some point in the time in the future, they'll probably come back in line. So what's a likely scenario? In my opinion, I think a likely scenario is we're going to have some type of jolt to the south side, to the downside. Is the 20 SMA the most popular? When you're talking about Bollinger Bands, I would agree with you. But when it comes to just regular moving average, because again, what is the Bollinger Band indicator? Basically, it's just a moving average with a volatility around that moving average. So the more popular of moving average that you use, then the more credence that you'll have in that indicator. So 20-period simple moving average is a popular moving average. 50 is another popular. 100, 200. The problem with using a larger one than 50 is that you're not going to get a whole lot of movement on the distance between the bands. It's going to be hard to generate trading opportunities. I haven't done this, but I guess if taken to task, I might consider it on a smaller time frame chart, like a 100 or a 200 simple moving average on the Bollinger Bands. Because if you think about it, if you're using an hourly chart, you've got 24 hours in a daily candle. And if you're trading something like the dollar Swiss, then 20 candles, and if you're looking at the Bollinger Bands on an hourly chart, you're really not going to get a good read of where prices are going to move. It just may be a function of the fact that nobody's interested in trading the dollar Swiss for that day. So in that case, if I were using a smaller time frame chart, again, I don't do this, but if taken to task, I might consider it, is on a smaller time frame chart like an hourly chart, stretching out the length of the Bollinger Bands or the moving average to 100 or a 200 period. Is 50 too much? No, again, it's a popular moving average, and so you're taking in 50 days worth of data, 2 weeks worth of data, and again, all that I'm looking for is I'm looking for elongated periods of low volatility. So 10 weeks, 12 weeks, 15 weeks of low volatility, yes, that tells me that the markets are getting very complacent and that this price is very comfortable trading inside this range, and so I'm just going to wait, sit on the sidelines and wait for prices to break through this range, and then I'm going to jump in. So one of the great things about trading a breakout strategy is that you don't have to necessarily predict where the prices are going to go. You let the market tell you where the prices want to go, and then you simply follow. There's a lot of services out there, a lot of traders who are always trying to predict where prices may move, and it's a very, very difficult thing to do because the market's going to do what the market's going to do. And just like last night, President Obama delivered his State of the Union address and talking about putting a cap on some of the spending and trying to reel in some of the spending. Now, there's a way that you could spin that to be dollar bullish. There's a way that you could spin that to be dollar bearish. So the point of bringing that up is we can maybe try to anticipate what may happen, but in the end, we have no idea how the collective traders, how all of the traders who are trading that instrument are going to react to that news event. And yeah, picking tops and bottoms is very difficult. And another thing that would also lend me to believe that this Aussie yen may break to the downside, and again, I'm just picking up clues. I don't know for sure what's going to happen. I'm just out walking along the beach, picking up clues. And so when the tide's coming in, then that means I need to maybe go home. If the tide's coming in, the sun's going down, that means that the day's about over, okay? It doesn't always mean whenever the tide comes in and it gets dark out that the day's about over, because maybe there's a storm cloud brewing on the horizon. But I'm just picking up clues, and one of the clues that we have out there is SSI, which is a proprietary indicator to Daily FX and FXCM. SSI is showing that a lot of traders are going long the dollar yen. A lot of traders are expecting the yen to get weaker. and it's a pretty significant number right now, and the trend on the dollar yen is to the downside, and so a lot of these traders, I think, are trying to pick bottom on this dollar yen pair. How does that relate to the Aussie yen? Well, there is going to be some relationship between the dollar yen, the CAD yen, the Aussie yen, the Kiwi yen, the pound yen. So a lot of these traders are expecting the yen to get weaker, and a lot of times they tend to be wrong. So that's also got me leaning to the downside on this currency pair as well. Fernando says, do you take breakout from support and resistance or from Bollinger Bands? The answer to your question is yes. It's however you want to do it. Now, support and resistance, in this case of the Aussie yen, let me change this back to the 50 period. We've got the lower Bollinger Band, which is very close to the lows of these candles. So whether you're using the lower Bollinger Band or whether you're using the low of these candles, you're only fussing over maybe 10 or 15 pips on a daily chart. In the whole scheme of things, it's not a big deal. In this case, since they are very close, I'm going to want to take the more conservative approach and wait for that break below the low of these candles. And so that's where I'm going to be looking for an entry in that 81.45 area. So we're about 33 pips above that level right now. And then again, take a stop. If prices were to move south, whatever candle it is that creates that break to the south side, whatever candle that is, place a stop just above the high of that candle. And got to make sure that you're looking at a daily chart, and then look to take a 1 to 2 risk to reward ratio. That means whatever the distance is to your stop, twice that distance is going to be your take profit or limit level. Now, if we did not have this kind of support shelf that was forming, then yes, you would look for a break below that lower band. And then the same type of thing. Whatever candle broke the band, that's going to be the high of that. If it's a short trade, is where you're going to look to place the stop. Now, we do have some videos that go over this, and so at the end, actually, I'll go ahead and do it now. Send me an email, and I'll send you some resources that talk more about Bollinger Bandwidth. And also, we got a 60-minute video that talks about the Bollinger Bandwidth and how it's used in conjunction with a couple other indicators. And then also, if you want more information on the strategy, I'll provide you with a temporary access to the course that we offer. And then you can go out and you can check out this strategy and the others that we have out there as well. Now Lynn's got a question here. Do I trade using multiple time frames to see what cycle you were in or the overall cycles, or strictly use a break off in the one time frame? What I will do is start off with the daily time frame. Now, this Bollinger Band strategy that I'm sharing with you today, it is, in my opinion, a one time frame type of strategy, daily charts. And I will use Bollinger Bands mostly on daily charts. I will look at it on smaller time frame charts, but to me, the most important information I can glean from Bollinger Bands is going to be off of the daily charts. And so I will, every few weeks, I will scroll through all of the currency pairs. Euro dollar, pound dollar, dollar yen. I'll go through the list of 30 of them. And I'll just identify any patterns I'm noticing with the Bollinger Bands and with this oscillator. And one of the patterns that I found out is that the Aussie yen, very low volatility. Okay, let me just move this back in time. You can kind of get a historical feel for it. And then let me go ahead and pair as well. The Aussie yen, the CAD yen. Notice the CAD yen. Look at the volatility. This thing has fallen off of a cliff. Now, what I find interesting that the volatility is dropping off is we had a very volatile moment here on the CAD yen and Aussie yen, and really all of these, the CAD yen, Aussie yen, Kiwi yen, the commodity currencies relative to the yen, okay? They all show a similar pattern. Very volatile period earlier in 2010, that flash crash, and they've only retraced a portion of that flash crash. And so that just by itself is indicating me that the overall trend is down. Now, does that mean it's going to start selling off here in the next 5 minutes? Well, no. Could it start selling off in the next, week? Well, maybe. But it doesn't mean it has to start selling off. This is just a clue that I'm just picking up from the market that we had a very volatile moment, and it is struggling to retrace this volatile period. And it's getting very quiet of low volatility. And so if volatility were to re-exert itself, I would be looking or leaning to the short side. Let me go ahead and change this over to the Kiwi yen so we can get a look at it as well. And you can see it's only retraced a portion of this down move in May. And let's even go back to 2006, or 2008 rather. Remember that very volatile period in the fourth quarter of 2008? Credit markets were freezing up. The world was starting to melt. Well, look here at the Bollinger Bands. Look where my cursor is here. Let me zoom this in. Look right here. Look how tight these Bollinger Bands are. And that was in July of 2008. And then notice how the volatility started to pick up. Prices broke below the lower band, and it started to ride that lower band here to the downside. So that's what can happen if you find the right trade, if you find the right environment. And when you've got an extended period of low volatility, you're going to be more apt to see something like this follow. You might get a head fake or two, or three, or six, but when you get extremely low volatility, it tends to be followed up with a high period of volatility. Do I trade only off of daily charts? No. Using Bollinger Bands, using Bollinger Bandwidth, I will apply that to daily charts. I will look at smaller time frame charts, but I'll use other types of analysis. So, for example, coming up on February 23rd, we're going to be talking about Fibonacci. We're going to be talking about Elliott Wave. And I just have a natural eye for wanting to identify some Elliott Wave patterns and try to use that into my trading. So with that type of strategy, you could use it on any time frame. You could use it on a 5-minute chart. But I find myself trading using between the 1 and the 4-hour chart. And then occasionally, for kicks and giggles, I'll move down to a smaller time frame like a 15-minute chart and trade looking for looking for Elliott Wave patterns and a couple of other patterns. And so here was let me give you an example here. Let me change the chart to the Euro Aussie. Just a moment. Yeah, so here was a trading opportunity that I wrote about yesterday, and that I think these highs, an aggressive trader may want to look to place a stop just above these highs. More conservative trader may want to look to place a stop just above these highs. But this trend, I'm going to see if this thing is going to re-exert itself to the downside. And with prices moving back up, we got this long wick right here. This may be just aside from whatever the topic is for today, trading breakouts, using a retracement type of strategy, even Fibonacci. This might be a reasonable entry to go ahead and go short as well. Len says, I overlaid the 2 and the 1 deviation on the Bollinger Bands to look for the price to channel within the 2 different deviations. And that's, one way to look at it if you want to get familiar with looking at breakouts using Bollinger Bands. A lot of times prices will not move much above the 2 standard deviation. So a lot of time prices will ride, if there is a strong trend, prices will ride in between that 1 and 2 standard deviations. But maybe a simpler way, because it gets to be a lot of lines on the chart, a simpler way of looking at it is just look for a break above the upper band or a break below the 1 deviation lower band. And then if prices move back inside, you could use that as an exit signal, or just use twice the distance to your stop as your take profit level. Because, these types of trends, what we saw in the euro dollar, And they changed my chart back to the euro dollar. What we saw in the euro dollar was does happen, but just because we've seen a couple of instances of it happening on the euro dollar doesn't mean it's going to happen, every time moving forward. Whoops, I need the one deviation. Where it rides up along the one deviation, that does happen. It helps if you find a very strong trending currency pair. All right, I got just a couple of minutes left here, and so I want to make sure that I get some information out to you. First of all, I've got a video. It's about a 60-minute video, and there's a couple of other videos that come along with it. It talks about Bollinger Bandwidth. It talks about, it even includes ATR, which is another way that you can use to gauge volatility in the market. And so I'd be more than happy to send that out to you. Send me an email, instructor@dailyfx.com, and I'll get that right back to you. Also, if you want to check out this strategy that we've got inside the Daily FX Plus trading course, send me an email. I'll provide you some temporary access as well, just for simply being a student of FX Street and joining me here. So that would be a parting gift that I'd be willing to offer to you here. And so with that, I look forward to receiving your emails. And let me go ahead and grab a couple more questions here. What is the setup for the Bollinger Bands on MT4? With my setup periods is 50, and I'm getting different info. On the Bollinger Bands, you're going to have two input settings. You might actually have three. And I think with MT4, I don't use it, but I think with MT4, a third setting you might have is the whether you want to use an SMA or whether you want to use an EMA, a simple moving average or an exponential moving average. Now, I always stick with the simple moving average. It doesn't make a hill of beans one way or the other, whether you use the exponential or the simple moving average, but that could be one of the reasons why your setup is looking different. And then so 50 periods, 2 standard deviations. If you're looking at the oscillator, 1 standard deviation if you're looking at the actual bands and looking for a breakout above or breakout below. And Jack's asking about the euro dollar 1 hour time frame. Let's just give this a quick analysis. What exactly are you wanting to see on the 1 hour time frame, Jack? Is there something specifically that you're looking for? Seeing this, taking a look here, maybe just eyeballing some Elliott Wave, we may have something that looks like this. A 1, a 2. You remember, five waves detect the direction of the trend. And so since we are on a 1 hour time frame, we got to keep in mind that since we are appearing to see 5 waves to the upside, this just simply means that the 1 hour time frame, 1 hour trend is to the upside, but the overall daily trend could be down. And these last couple of candles, are they bullish? Let me get rid of these Bollinger Bands. One may look to draw a support line, something like this. So, yeah, that is definitely a bullish engulfing blue candle that we see here, and that is a bullish candle formation. However, this candle formed nowhere near my support line. So therefore, I would give less importance to this bullish engulfing candle formation. If this bullish engulfing candle formation occurred right on top of my upward sloping support line, then I would give more credence to it and I would feel better about this bullish move to the upside. But since this occurred really in no man's land, in the middle of nowhere, this could just be a big candle formation. And but we do have a lot of wicks to the upside, couple of dojis here. Prices just are struggling to make any net progress one way or another. And so again, that's where you're going to be looking towards a breakout type of strategy. And let the prices prove to you where they want to go, and then you're simply going to follow it. And so in this case, if you have an opinion that you think the euro dollar may move to the downside, well, you know what? Wait for prices to break below this trend line before you initiate that short trade. And then the good thing is as traders, obviously we want to go out and find winning trades, but we also have a lot of losing trades as well. Well, the good thing about breakouts is if you think that prices are going to move down and that if prices end up moving up, well, if you're using a breakout style of trading and if you never get entered into the trade, that means that you never get entered into a losing trade, which is very important. So wait for prices to prove to you that they're wanting to go down, and a break of this line would be a confirmation on that. All right, well, I have run out of time here in the webinar room, and I do want to thank you guys for joining me. I look forward to receiving an email from you and communicating with you that way on these videos that talk about the Bollinger Band width. And I'll be back here in 2 weeks, and in 2 weeks we're going to be talking more about breakouts and another indicator that perhaps you might be familiar with and how to employ that on looking for a breakout type of strategy. And then back on February 23rd, we're going to follow up with using Fibonacci and Elliott Wave, which tends to be a very dynamic and riveting type of webinar. A lot of people, when we do these webinars at DailyFX, a lot of people get very excited about Elliott Wave. So look forward to seeing you guys back here in a couple of weeks. And I want to wish you guys the best of luck in your trading. We'll talk to you guys soon. Bye now.